Okay, welcome back to another webinar. It's Monday and Fridays are webinar days, Princeton University's webinar. Today we co-teamed up with SFS, Society for Financial Studies, who run the review of financial studies. And we're very happy to have Jeremy with us. Hi, Jeremy. And so Jeremy will talk about the evaluation of the Fed-Treasury credit programs. So very excited to have him here. Jeremy is the chair of the economics department at Harvard University and also was governor at the Federal Reserve Board, as well as working at the US Treasury during the financial crisis. So he has first-hand experience with crisis fighting, and he will give us his experience and take on the current programs. As usual, let me do some introductory remarks. We had already some evaluation of the Fed programs very early on, before all of them were really launched with Nelly Lang. And today we get a different perspective. Last Friday, Daron Acemoglu was talking about the benefits of targeted policies, in particular to fight the health component. And on Friday, Paul Krugman will talk about the audacity of slope, not of hope, but of slope. Then we have more speakers coming up. You can see some of them. Next Monday will be John Cochran talking as well. Let me start a little bit with the three crises. We had this this slide already before. We had a health crisis, an economic crisis, and today we talk very much about the financial crisis as well, how the economic crisis and health crisis spills over the financial crisis, and how to manage the financial system to make sure that all problems in financial systems don't feed back in the economy and make the situation much worse. First, I would like to contrast the 2008 crisis with the 2020 crisis. And I mentioned already that Jeremy has first experience with the 2008 crisis. But what's so different? In the 2008 crisis, we had essentially a buildup of imbalances. We had a huge run-up of credit and very thinly capitalized banks and shadow banks. While in 2000, we had a huge run-up of government debt, and the budget was actually in deficit. And there was, of course, also a risk, but in general, balance it was a re-evaluation shock of especially real estate. We totally underestimated the real regional correlation of real estate prices across the regions in the United States. That led to all the structured products to get into difficulties. Today, I think the problem is much more that we have corporate cash flows are drying up. Suddenly the corporations can't sell anymore because of the lockdown, shutdown, and that leads to a decline in cash flow. So 2020 is much more cash flows. 2008 was more this classic discount factor moving around. So that was the trigger. What was the amplification? The amplification was, of course, balance sheets were impaired, in particular in the household sector and the banking sector. Now in 2020, the corporate sector is also has impaired balance sheets. So that's very different from 2008, where the corporate sector was much more sound than it is today. In terms of financial sector, banks and shadow banks were often part of the shadow banks. They were connected to particular banks. Now we have much more fintech and other aspects running there. In terms of structured products, Warren Buffett called CDOs, the weapons of mass destruction in finance. Now we have much more CLOs as well. In terms of policy objectives, it's very different. In 2008, it was all about let's stimulate the economy, get demand going again, and in order to stabilize the economy. Now it's much more about survival of companies. How can you make sure that we don't have to shut down all the companies? And in terms of speed, we thought the 2008 crisis was very fast, but 2020, the crisis is even much, much faster. So what should central banks do? Central banks who can either lend against collateral in the liquidity programs, or they can buy risky assets, so-called credit programs. Within the liquidity programs, once you lend against collateral, you have to set a haircut as a cushion if the value of the collateral goes down. You still have a downside risk if the collateral is losing value a lot and goes beyond the haircut cushion, then you still lose some money. And because you do lending, you don't have any upside potential, upside risk. There are two parts of liquidity programs. One is more the funding liquidity to make sure that firms and households and banks have sufficient funding. The other one is much more to provide funding such that the markets, the secondary markets function well. So to improve the secondary markets functioning. So you can either give funding to existing market makers to make sure the secondary markets funds with low bid and ask spreads, or you can actually intervene directly to be a market maker of last resort, as Boyd and Siebert called it in 2007. That's one program, the lending programs, and we have done a lot of them in 2008. What's more pronounced now are credit programs, and Jeremy will talk about them. You buy risky assets, and should the Fed buy risky assets or not, take on some risk essentially. I've worked on this on the I theory, and I will elaborate this a little bit, and there's a clear yes, there should. So you get essentially upside and downside risk. You can diversify the risk across the bonds you're buying. But the question is, which part of the government should buy it? Should it be the central bank? Should it be some development bank to co-invest in loans, like in many countries? In Germany, the KfW, the development bank, is doing the co-investment and protecting the central bank. Or should it be the fiscal authority? In the US, it's essentially a combination of the fiscal authorities and the central bank. So you have a pool of assets bought by some special purpose vehicles, SPVs, and then the Treasury is taking the equity tranche. So the first losses will be absorbed by the Treasury. So first you have diversification benefits because you buy a whole pool of assets. Some might pay off and you make a high return on them. Some of them you might lose value. And then the Fed essentially is taking the liquidity cushion. Hopefully there will be no losses on that. So that's essentially buying the programs. More generally, I think what's important is that monetary policy should not only work on the risk-free rate, but also on the spreads. So you should have, the risk-free rate is of course what standard conventional monetary policy works on, but you should also be able to work on the spread, in particular on the term spread. You can have some yield curve management. QE did this when you buy treasuries, or yield curve management is very actively done by the Bank of Japan, but you can also manage a credit spread. So essentially what you have the policy rate at the short end. As you increase the maturity, you get a term spread, and as you increase the credit risk, you get a credit spread on top of it. And that's essentially what the central bank can do. And you can affect, by taking on some of these risks, you can actually affect the risk premium, and you want to manage this risk premium to some extent. You can affect the price of risk, and you can also affect the risk and the risk itself. So the risk premium is the product of the price of risk times the risk, and the risk itself consists of an exogenous risk, which you cannot affect, and an endogenous risk, which is due to amplifications, spirals, runs, and nonlinearities in the system. And if you redistribute the risk more widely and more efficiently, you can minimize the endogenous risk. And as the endogenous risk is minimized, also the risk which has to be borne is reduced, and then the price of risk is going down too. So it's all about redistributing risk. And in terms of crisis, you have to ensure that the risk is well distributed in order to minimize it, and also to minimize the price of risk, and therefore the risk premium. Essentially, government steps in as an intermediary, redistributes risk, and creates money. What we show in the I theory, this also then has some advantage on the inflationary side, which will not be the focus today. That's, it reduces the deflationary pressures this way. So the question is, which assets should the central bank buy in a world where, you have a risk perspective, you want to manage the risk premium, and it's not necessarily about consumption demand management, which is the focus of the Keynesian approach. And the way to look at it is essentially to figure out where's the bottleneck first. It's a bottleneck approach. Is it in the financial sector? Is it in the household sector? Or is it in the corporate sector? And each crisis is different. Like the last crisis in 2008 was very much in the financial sector, and particularly in the household sector. That's why mortgage-backed securities were bought, and you bring the mortgage rates down, you support house prices, and this helps the household sector. Nothing much was done on the corporate sector. Now, in this crisis, the corporate sector is highly involved as well. And that's why the asset purchase programs have to be targeted and first see where the biggest bottleneck. That's essentially which assets you want to buy. You want to buy government bonds, mortgages, or corporate bonds. Then there's also a question of sequencing and the interaction, because it's a government program, between the DMOs, the debt management offices, the treasuries, and the central banks. The other important question is, how should you buy it? Should you buy it via auctions, or should you do it like a foreign exchange interventions for emerging economies? You want to defend certain asset prices, and you intervene when the market is particularly thin in order to push up the price at that time, or you just fix a certain quantity and just buy it straight out. So that's the question, how to design the purchase programs in particular. Is it just an asset price target, or is it just fixed quantity? And these are important questions. Of course, negative interest rates come into play as well. So let me finally point out a proposal I did with Arvind Krishnamurti. What's interesting is that in this crisis, everything is inversed, everything is upside down. And that's why we have this picture here where you see a man walking, where everything is upside down. The do's are don'ts, and the don'ts will become do's. Okay, in a usual recession, as I mentioned earlier, you want to stimulate the economy. You cut interest rate to stimulate spending and investment and go everything on. In the COVID recession now, it's all about survival, making sure the companies survive. And how can you make sure the companies can survive? And how you get this inverse policy prescriptions. Essentially, if you have large companies, it's fine because you can do Chapter 11. It's a good solution for large companies because you don't even notice for the real economy. You wipe out the equity holders. The management will stay the same and the operation will stay the same, but you can just wipe out the passive equity holders, and it doesn't really have some big implications. But for small and medium enterprises, that's different because the equity holders typically run the firm and they need to be incentivized to do the right thing and be able to run it. So the Chapter 11 typically doesn't work so well on small and medium enterprises. And usually what we do in recession when we stimulate the economy, we avoid evergreening, because whenever do evergreening like it's done in Japan, it crowds out new credit to new startups and new firms which are more productive, and then overall the whole economy is more productive. So the usual approach is to restructure, let small firms and big firms restructure them or let them go down in order to devote the new credit to new firms, new startups, and so forth, to the productive firms. Now in the COVID recession, it's different. We want to promote survival, and paradoxically, we want to promote then evergreening, which means evergreening, you refinance, roll over a debt to companies which can't pay back their old debt. So instead of saying, okay, the debt is due, you have to pay it now, saying, okay, I give you a new loan and you can pay back the old one. And the central bank should actually support that and allow banks to cheaply refinance any loan they're granted. So if they have granted a loan which is due and they're granted a new loan to pay the old one off, you can bring the new loan as very good collateral at a very low interest rate to the central bank to refinance it from the central bank money. So that's essentially one way to go. So I want to conclude my introductory remarks with a few poll questions to get your sense out of it. And so we're starting a little poll as usual. So do you think that the Fed benefited from this crisis experience in 2007, 2009? So all the programs are put up now very fast. Was it because they had all the crisis experiences in the earlier crisis? And that's a big benefit we're having now because of the past crisis. That's the first question, yes or no. The second question concerns the paradox of prudence, a concept which introduced, which is like saying assuming risk and redistributing the risk across nominal and claim holders can reduce the overall risk to such an extent that actually, it's beneficial to do so. Or do you think risk is a zero-sum game? And many people say it's a whack-a-mole game. You control the risk in one, it pops up on the other side. So do you think it's a zero-sum game, or just redistributing risk more efficiently among many nominal claim holders will reduce it? And finally, do you think should the Fed take on some credit risk and redistribute it among many claim holders? Yes. or no, because the Fed will actually risk its independence. So this does not mean should the government do it, so it could also be a development bank or some Fed Treasury interaction. Should the Fed do it on its own or not? And the question is, the answers then are yes or no, depending on what you're saying. So I give you a few seconds to complete the answers, and then we move on. Okay. So what are the answers? Did the Fed benefit from the crisis experience? Yes, 91% say yes, and only 9% say no. There's a clear benefit from having had the crisis, so all information is not lost. We still have it out there. What's about the paradox of prudence? Connection is assuming risk and redistributing is this beneficial, reduces overall risk. 82% say yes, very strong, and only 18% say it's a zero-sum game. So it's pure whack-a-mole game. No, it's, I think, the majority, 82% think there's a benefit from redistributing it better, potentially with government intervention. And should the Fed do it, take on credit risk? 56% yes, the Fed should take on credit risk, and 44% think they should not because they might sacrifice or hurt the independence. So with this, I would like to conclude my introductory remarks and move the floor on to Jeremy. Thanks again, Jeremy, for being with us. And I will now stop my sharing and you.
All right. I hope people can hear me. Markus, thanks very much for inviting me to do this, and it's a pleasure to be able to present to this group, even though I can't see any of you. I'm assuming that you're out there. So I'm going to talk about, as Markus said, the Fed Treasury credit programs. All of what I'm going to say, or at least some of what I'm going to say, is based on ongoing joint work with Sam Hansen and Adi Sundaram from HBS and Eric Zwick from Chicago. Now, just to be clear, when I talk about the Fed Treasury programs, there's a lot of programs. There's a whole alphabet soup of stuff out there. I'm going to focus on the two that are most in the spirit of longer-term credit provision, as opposed to shorter-term liquidity type programs. So those two are, first of all, there are bond buying programs. Basically, the Fed and Treasury together are going to buy corporate bonds. There's what's called the primary market corporate credit facility and the secondary market corporate credit facility. I'm going to focus largely on the former of those, in which the government will essentially buy bonds that are directly issued by corporations. And then I'm going to speak also to, and those are for the largest investment grade companies. And then I'll say something also about the suite of Main Street, so-called Main Street programs, which are aimed at essentially medium-sized companies. Okay, just to sort of frame the question, you might ask, what is the logic of credit programs as opposed to, say, direct household support via, say, unemployment insurance? Now, obviously, we're dealing with a massive, maybe unprecedentedly large shock. There's going to be a large loss of output. We're already seeing staggering unemployment. I think if you wrote down the simplest, most frictionless kind of model, there would immediately be an obvious role for some kind of household insurance, unemployment insurance, or something like that, to at least partially smooth consumption. You're not going to get it all the way smooth, and people can't do a lot of the stuff that they normally do, but you want to be able to keep people in their homes and fed, and basically allow them to weather the crisis. I think that part is clear. The logic of corporate support, of giving money in some form or another to companies, is a little bit less clear. And the way to say that most starkly, if you think of the simplest world where there's labor and capital, we sort of know we need to help labor. If you think of the capital as being sort of a manufacturing plant, you might say, well, as long as the plant doesn't get torn down, as long as we don't reallocate the physical capital to a second best use, well, then life will proceed when the economy wakes up. And I think that would be sort of true in the most frictionless world. I'm going to try and focus on two sorts of frictions here. One is the bankruptcy process. Again, in an idealized world, you could imagine that the plant would stay put and that all that would happen in bankruptcy would be that losses would be allocated. Essentially, the debt holders would see their debts written down, maybe they'd be converted somewhat to equity, but the plant would not get allocated to a second best use. Now, that's just not the real world, and I'll talk about that. So that's one of the things you want to deal with. The second is a set of financial amplification mechanisms, such as if you do allocate large losses to creditors, some of them will be highly leveraged intermediaries like banks. You need to then worry about the bank's balance sheets. You need to worry about how will the corporate bond market respond to the prospect of very large losses. Will there be fire sales in the corporate bond market that also constrain the supply of credit? And there are sort of other mechanisms in that way. So I think those make it less easy and motivate some thinking about doing something for the corporate sector as well. And I just want to flag that of these two frictions, sometimes doing better on one, unfortunately, makes you do worse on the other. So you might say, well, what if we had a wonderfully efficient bankruptcy system that left the plant in place, but just allocated very large losses to the creditors? Okay, that might be good for sort of the productive efficiency of the plant, but of course that might be worse for the bank balance sheets or for the bondholders and therefore for some of the amplification mechanisms. Okay, so very interesting that Markus did this poll and asked if the Fed learned something from last time around. And I think, of course, it did. And much of what it learned, I think, is to the good. And many of the programs that we've seen rolled out were able to be rolled out more quickly, thankfully, because the Fed had some of them on the shelf. But a major theme of what I want to say is you don't want to carry the lessons of the last crisis too literally and too narrowly. So, as I said, we don't have a great off-the-shelf theory of how we should do corporate lending in this case. We do have an off-the-shelf theory that fits the last time around a little bit better. So this is the sort of classic idea of the central bank, or maybe the central bank combined with the Treasury, as a lender of last resort. So for those of you who are at all familiar with sort of central banking, there's this old idea, it goes back to Bagehot, who was writing about the Bank of England, who said what a lender of last resort should do is, and all the words here are kind of important, is lend freely to solvent firms against good collateral and at a penalty rate. So the basic idea of this is you should be lending to firms that are fundamentally solvent, that you know are basically good credits, but that have a liquidity problem. And you know what's nice about this this Bagehot dictum is it maps very clearly into a particular kind of model. So think of the Diamond Dibfig bank run model, where there's sort of fundamentally sound banks or fundamentally sound economy, but there's a run. In that kind of setting, doing the lender of last resort thing is exactly right. You can lend, you can basically break the liquidity, the bad run equilibrium, break the liquidity problem. When you're done doing that, you're left with a good no run equilibrium. In that equilibrium, everybody is solvent and everything will work out fine and you won't lose a lot of money as the government. And in hindsight, and I want to stress hindsight, because I think there was a good bit of luck involved. You know, you could look back at 2008, and this is where I want to be careful about the lessons that you draw. You could look back at 2008, 2009 and say, yeah, this was sort of like mostly a liquidity crisis, and this lender of last resort approach served us quite well. In other words, not only did the Fed not lose any money, but the Treasury, the TARP, which was effectively the junior and more exposed participant, was almost entirely repaid. So again, ex post with a little bit of luck and some other kind of good stuff, it looks like it was a liquidity crisis. We got the money back. There was not a lot of lending to firms that after the fact proved to be insolvent. And so that kind of worked. Now, of course, I don't want to at all leave the impression that there weren't serious solvency concerns ex ante, but you know, thanks to other interventions, and again, thanks to just sort of the way things played out, ex post, you could have looked at this and a simple takeaway would have been lender of last resort works well. That's how you treat a crisis. Okay, and I'm being a bit of a smartass here, but it feels to me a little bit. Now Marcus asked, should the Fed be willing to take losses? And in that survey, you guys were split. I think the sort of operative question really for the policy right now is not whether the Fed should be prepared to take losses, because there's quite a bit of fiscal support. The question is whether the Treasury, again, as the junior partner, is itself even willing to take significant exposure to loss. And that's why I put up this Wall Street Journal piece here, where basically Steve Mnuchin says that although Congress appropriated $450 billion to the Treasury, that his view is that the correct design is one in which not only will the senior lender, the Fed, get paid back, but the Treasury get paid back as well. And it has, again, very much a feeling of, that's the lesson we learned in the last crisis, that the Paulson Geithner Treasuries got paid back, and maybe we should have a similar design. So basically, I have one point, and my one point is, and it's sort of, again, interesting that Marcus asked this as one of the poll questions. This is not 2008, 2009. Not to say that we didn't learn some good stuff then, but I don't think you want to think that, the tools that were fit for purpose then are going to be the tools that are fit for purpose now. First of all, just the magnitude of the shock is much larger. The fundamental shock last time around, you could say, were mortgage, losses on subprime mortgages. That's maybe ballpark 500 billion, maybe $1 trillion max. And a lot of the damage was not that initial shock. It was the sort of run-like propagation mechanisms, which again, the lender of last resort was well suited to deal with. Here, the magnitude is going to be in the several trillions at least. And the idea that we can know with any kind of clarity who is solvent at this point, or who is going to be solvent, is really a stretch. I think the dominant thing, and the dominant thing you want to care about for policy design, is the fact that the uncertainty here is really the first order consideration. We don't know how long the crisis will last, when people in different industries and in different parts of the country will be able to go back to work or go back to consuming different types of goods. We don't know when the restaurants are going to be busy again, when airlines are going to be half busy again. And we don't know to a large extent, even after the virus is, even after we have, say, a vaccine, whether we'll have a real realignment. I mean, it may be that airlines will be forever different because we've all learned to do conferences by Zoom. Okay. Moreover, it's just a little less clear even what we mean by solvency. So normally you would say, well, if somebody has no revenues for like 12 months and they can't service their debt, they're insolvent in any sense of the word you might want to use, like they're just not a viable business. Not obviously the case here. You can think of a lot of examples of businesses where it's quite possible to have minimal revenues, not even be able to service quite modest debt loads, but they're going to be viable. So, probably nobody has gone for a dental checkup in the last couple of months. Nobody may go for the next 6 months. Really bad for a dental practice that has some debt, even if it has a modest amount of debt. I'm pretty hopeful and confident that people will go back to dentists, and that you don't want to sort of tear up dental offices and repurpose the equipment and all of that. All right, so with that in mind, what are sort of the highest level goals that you might hope for policy? And I've split them into two. One is sort of, you might think of it as a micro efficiency type of goal, and the other is sort of more in the vein of containing macro amplification mechanisms. At the micro level, you don't want to destroy firms either in a sort of tearing up the physical or organizational capital sense of the word, if these are long-run, post-crisis viable firms. If it's a negative NPV investment, to do that. Okay, and again, the goal is not to shield debt and equity investors from losses. And in some idealized world where you could essentially, just put the losses on the bondholders, but leave the assets, again, physical and organizational, in their first best use, that would be a good thing. We know there's a large body of research that says that the bankruptcy system doesn't always get that right, and that the process of trying to restructure the financial side often leads to an imperfect allocation on the real side. And a couple of points I wanted to kind of emphasize there. I think especially, you may be thinking of airlines and things like that, and the airline keeps running while it's in Chapter 11. For smaller firms, of course, who are very, very hard hit, there's more of a bias towards just indiscriminate liquidation. That's point number one. Point number two is, even to the extent that the bankruptcy system for larger firms works tolerably well in normal times, there's some quite compelling research. This is some work by Ben Iverson, that the bankruptcy system has real capacity constraints. So this work looked at what was sort of arguably an exogenous shift in the time that judges had to spend on corporate bankruptcy cases, because after the consumer bankruptcy reform, there were many fewer consumer bankruptcies, so judges had more time to spend on corporate bankruptcies, and looked at the outcomes. And basically, the evidence is pretty clear that the less time that the bankruptcy courts have to handle corporate bankruptcies, the less efficient are the outcomes. And the magnitudes are pretty significant. Let's see, I wrote it down for myself. Basically, now there's a fair amount of external validity stuff here, but if you take this stuff, if you take Ben's work, even during a normal recession, this is sort of a normal garden variety recession, bankruptcy caseload goes up by something on the order of 50%. And that 50% increase, if you take his estimates and extrapolate them, would imply an increase in the losses to debt holders of something like 32 percentage points, as against a base rate loss of 36 percentage points. That is to say, even a garden variety recession clogs up the bankruptcy system to a point where, roughly speaking, we double the losses that are created. And again, all concerns, with all respect to concerns about external validity, I think that might make you worry a little bit about putting a very large chunk of the economy through bankruptcy. So much as there's a sort of flattening the curve notion with respect to hospital capacity, I think you might make an argument for flattening the curve here as well. Okay, and then as I said, there's a host of the sort of usual macro amplification mechanisms, balance sheets, whether they be balance sheets of banks, whether they be fire sales in markets, and so forth. And again, there's some tension here between micro and macro efficiency. I've heard some say, well, if the bankruptcy courts get really, really busy, they just won't process any of the cases. So nothing will happen. These companies will all be in suspended animation. We won't have any liquidations. And so micro efficiency won't be too badly affected. Okay, but even if you take that as given, and I'm not sure you should, even if you take that as given, think about now the bank or the bondholder who's told, you're lending to a firm that's in the bankruptcy court, but we're not going to get to them for 2 years. That's probably not a great thing in terms of, imagine sort of the sell-off that happens in credit markets, the pressure on bond funds, and that sort of thing. So often containing the micro thing might lead you to doing a little bit more damage. If there's no external assistance and you just let the market work itself out, may lead to more damage on the macro thing. So I think these are the problems you're trying to contain. So in this work with Sam and Adi and Eric, what we try to do is lay out a set of sort of core design principles for how one should think about this, and to try to draw the contrast with lender of last resort. You might say we think in this case, because the most first order thing is uncertainty, you don't want to think of yourself as a sort of senior lender of last resort that's only extending credit to firms that you're sure can pay you back, but rather you're making a collection of very risky investments. There may be great social value to those investments, but you're more in the mode of what we call venture capitalist of last resort. Okay, And what are the lessons we've learned from venture capital in dealing with financing under great uncertainty? You can't really go about protecting yourself as the lender by just saying, I'm only going to, advance financing to people I'm sure are going to pay me back. If you do that, you'll lend to a few investment grade firms, but you won't be really addressing the problem. The way you protect yourself in venture capital is with staged financing. You put out just a little bit of money at first, and then you wait and you see how things develop. And as the uncertainty resolves itself, if things sort of branch to the good state, maybe you're willing to put in a little bit more. If things branch to the bad state, you cut your losses, but don't lend as much. So this is very much almost the flip of Bagehot, who says, if they're solvent enough, lend without limit, right? I would not be lending without limit, but I would be a little bit less stringent on the idea of they have to be absolutely solvent. And the corollary is you obviously have to be willing to lose money. There are probably a few really safe loans you can find, but if you do that, you're not going to be treating the fundamental problem. So again, I would make a
Jeremy,
yeah.
There's some questions about Bagehot. They said mostly Bagehot is addressing it towards the banks, but you're going a step further to say, okay, lending to firms directly, or would it work via banks?
Yeah.
And the other thing is, to what extent do you want to diversify venture capitalists in many of these funding structures?
I'm being purposefully blurry.
And if I make losses on some and gains on others.
Yeah, I'm being purposefully blurry because, of course, in the more usual type of programs that we've had, the Fed is, at least in the most plain vanilla, the Fed is lending directly to banks. Here we have the government broadly lending to the corporate sector. And I guess I'm making the sort of assertion, or maybe it's just a caricature, that the Bagehot type of thinking has nevertheless kind of had an influence on design. Okay, and in so doing, I've sort of blurred lending to firms versus lending to intermediaries, basically. Okay, so again, I think you start thinking about this as what do you do? What is this is basic at some level? It's basic corporate finance. I think if you realize that you're lending in a situation of very high uncertainty, from a social perspective, this may be a very positive NPV thing to do for all the reasons outlined, but there's a certain kind of financing arrangement that makes sense for a liquidity problem. There's a different kind of financing arrangement that makes sense when you're dealing with just great uncertainty about the underlying viability of the business. So some of it is this finance staging. The other is the type of claim. Again, if you are sort of in this Bagehot mindset set, the Fed takes a senior position. Basically, they want to get paid back first. They want, again, it's this principle of against good collateral, right? You want to be strongly secured. You'll see, I'll show you, this has really pervaded the thinking, the sort of micro design of these programs. I think it's problematic. I would much rather that these loans, if you will, get made not with senior debt, but with something that looks like you would see again in a venture capital context, something that looks more like preferred, maybe preferred plus warrants. Why is that? Even if we get clear of the most immediate crisis, so suppose it's 18 months, 2 years down the road, and we're emerging, of course, we're still emerging at a time of maybe 10, 12% unemployment. Is what you want to have a bunch of firms that are saddled with a very high debt burden, with very large principal repayments, unable to bring on any new financing because of debt overhang? Or would you like to have a softer, more junior claim, which promotes their ability to kind of keep going, maybe bring on another round of financing if necessary? So, you don't want to kind of sort of, help them survive for the next year and then essentially kneecap them afterwards because they're stuck with a very, very heavy debt burden.
So Jeremy, Terry Kame asked, don't you risk then losing the independence if things go badly, if you take on all this risk? So the central bank might lose its independence?
Okay, so let me be clear again. I am not advocating, some people have advocated, and I can understand the argument, for the Fed to take sort of meaningful credit risk. There's $450 billion of congressionally approved fiscal support. And so in everything I'm saying, the way I'm envisioning it, is, you know, outside of a sort of relatively rare state of the world, these are losses that will accrue to the Treasury. Okay, and I'm extremely sensitive to this point about, maybe too sensitive to this point about insulating the Fed as best as possible. Okay, so that says, you know, maybe you have to scale the programs. They can't be that big because you want to have an adequate cushion. Essentially, if, you know, if, as I'm going to argue, you should be making riskier loans, then that demands a bigger equity contribution, obviously, than if you're making investment grade investments. So, you know, 95% what I'm arguing here is for more exposure of the Treasury to loss and not for the Fed. Okay, of course, there's nothing that I can do or say that any of you can do and say that says we'll protect absolutely every nickel, but that's the broad thrust. Okay, so again, a very, very broad brush. What are the sort of facilities? There are these corporate credit facilities, and again, very crude, you know, description. Think of them as set up to buy bonds, investment grade bonds, and actually bonds that were investment grade as of March from companies, and that's more or less it. That's the primary corporate credit facility. And then there's Main Street, which is for firms that are still sizable, but sort of a layer down. These are firms with up to 15,000 employees. Here, it's going to work a little bit differently and somewhat more complicatedly. The Fed-Treasury SPV will lend side by side with some banks that are asked to take a piece of the risk themselves. Okay, I'll show you a little bit more about that in a sec. And again, Marcus put up a picture which captures it well. There's essentially an intermediary, a special purpose vehicle set up. The Treasury is like the equity holder in that vehicle, and the Fed is like the senior lender. Okay.
So Bengt Holmström actually wants to know whether your scheme would involve some co-investment, like what development banks do.
So what I'm going to do right now, I'm going to get pretty into these specific programs, and I'm essentially taking the structure of these programs. I will describe them for you, and then I'm going to take the structure completely as given. I'm not going to try and do anything wild and different, and see how close can we get to the sort of broad design principles that we have. This is a very, very pragmatic, like talk to policymaker kind of exercise. I'm not trying to reimagine the world and, you know, totally reimagine the congressional constraints. Just within the existing construct, what are the little dials that we can tweak to get a little closer to sort of the vision that we think makes sense. Okay. So first thing to do is just to put all these programs sort of on a table and ask who is covered by them and are there any big holes. Okay. So as I said, if you look across the first row here, the primary credit facility, that's the thing that buys investment grade bonds. If you look at the public firm universe, this is all publicly traded firms, that only captures the top 12%, only very big firms, but it captures nearly 60% of employment and sales. Okay, so the very biggest firms who account for, you know, again, 60%-ish of employment, they'll be covered by this bond buying program. Okay, the Main Street program covers the next 33% of firms, not next, but covers another 33% and another roughly 16% of employment. Okay, but if you look at it, there is a significant chunk, and this is before we get to private firms, even among the public universe, there's a very significant chunk, about 26% of employment that gets missed by any of the programs. And that's basically for two reasons. The biggest is that you've got a set of firms that are too big for Main Street. They have more than the sort of maximum allowable number of employees, but they're not investment grade rated. Okay, so they're too big for Main Street, but on the credit rating, they fail to qualify for the primary market facility. Okay, and then there's a second set, a little bit smaller, well, it's bigger number, but smaller in terms of employment share, that fit within the size parameters of Main Street, but Main Street has a leverage criterion, and these guys are too risky in some sense, have too high a leverage ratio, so they're kicked out there as well. Okay, so the first thing I just want you to notice is that we have a lot of programs, but even before we get to the small firms, which are, you know, a whole set of problems too, we're already missing more than a quarter, in some sense, economically speaking, of the big firm universe. I'm going to skip the small firm thing. And again, I think one way to sort of think about it is back to this Mnuchin thing. If you don't want to lose money, one way to avoid losing money is to lend only to the highest credit quality firms. And so that's what they're doing. That's what they're doing.
So Jeremy,
yeah.
So David Wessel would like to know whether you think there's speculation that people will not even take on this program. So there's no pickup for the programs.
Yes.
Do you think that's on top of
Yes.
it?
Yes, I'm going to come to that. I'm going to come to that. So I should have said, thanks David for that. This is my 26% that are missed is of course a very loose lower bound for people who will ultimately not be touched by the program. These are guys who just can't like even, open the door. Okay. But there will be, and I'm going to do this a little bit more with Main Street because there are more restrictions. I think with the other, with the bond buying thing, the only other thing other than not being investment grade that would keep you out is some notion of stigma that, you don't want to be dealing with the government. With Main Street, there are a bunch of other very important gating factors that I think that make that question very important. Okay, so that was, I should have said that. So as I said, the spirit of what we're doing is not to try to completely reimagine the suite of programs from scratch, but to suggest some fairly modest tweaks. So here's a first very modest tweak. Well, maybe it's not modest, it's simple. It's simple, which is open the door a little bit on the primary market corporate credit facility. Again, they're not taking anybody who is not either investment grade or was not investment grade as of March something or other. I think we would argue, well, dial that back a little bit, admit the highest levels of junk, that is to say, admit double B and single B rated firms. You're taking more risk. There will be more risk of loss. One way to shore up the government's position, rather than just not letting them in, is, again, what do you do in risky finance where you can't all make it up with a sort of limited upside claim, is you take warrants. Okay, so I think that shores up the government's position, at least in an expected value sense. I think it helps to align incentives because firms won't, just be in it because they can get all the upside and stick the government with the downside because they'll have to give some of the upside away. There are in the Main Street program caps on executive comp and shareholder distributions. They are not present in the primary market credit facility. I think it makes sense to impose them, and it probably makes all the more sense as you start dealing with lower rated firms. Again, it's another way to protect yourself. And finally, again, I would push back against this idea that you set a set of firms and then you give them unlimited quantity. The way you deal with these lower rated firms, and I'll say something a little more specific in a moment, is to try to control the quantity rather than to just have a yes/no question. All right. Now let me turn to the Main Street programs. And here there is a suite of programs. There's 3 so far, and I think there may be more to come. One is called the New Loan, one is called Priority, and one is called Expanded. And now we're going to come to some of these other gating factors. So they have a term, there's a minimum loan size. Basically, the New and the Priority are for relatively smaller firms. The expanded loans are much bigger. There's a $10 million minimum loan size. And so that's sort of a different kettle of fish. I'm going to focus a little bit more on these two. A couple of things to note. First of all, there are leverage limits. Okay, so there's a relatively conservative debt to EBITDA cutoff for the new loans of 4 times. Okay? There's what's called risk retention. What that means is basically a bank originates the loan. A bank originates the loan and retains 5%, with the government taking the other 95. So another gating factor here is the bank has to be willing, essentially, to take that 5%. The loan must be on terms that are satisfactory to the bank. Okay. Another thing, back to my point about debt repayment, there's no interest due the first year. In years 2 through 4, not only do you pay interest, you have to pay 1/3 of the principal back, straight line, over those 3 years. So there's a very fast and aggressive principal repayment. Okay. Now, if you compare the priority loan version of this is a little bit more generous in the sense that it will allow you to take somewhat more leverage. It'll allow you to go to 6 times. It also has a somewhat less fast repayment schedule. Instead of being 33% each year, it's 15, 15, 70. Okay, what's the trade-off? They're basically protecting themselves with a stronger seniority position. In the priority loan program, the Fed-Treasury loan must be made senior to all non-mortgage debt. Okay, so again, it's a very much a sort of a mindset of how do we protect the government from loss. Either we can do it with sort of lower leverage loans and fast payback, or if we loosen those terms, we tighten by having more seniority. Okay, so now I want to come to this other gating thing. So I guess, why would you expect, or why would you ask the banks to take a stake here? Oh, and I should say, I meant to say, also in this priority loan thing, the other form of protection is they ask the banks to take a bigger stake. They ask them to take 15 rather than just 5. All right, so it's sort of, you know, the philosophy seems to be the government doesn't want to make a loan that the private sector doesn't see as commercially viable, doesn't see as, you know, something that a bank, you know, just for its own profit motive would want to do. So that is potentially, you know, relative to the social welfare kind of argument that we've been making, where we think the government has to basically stand ready to lose money when there's all these externalities that we've identified. It feels like asking the loans to be made on commercial terms is a very, very stringent, and doesn't seem to be the right criterion. I mean, if they're willing to make it on commercial terms, I don't quite see what the logic of government intervention is in the first place, unless you think the banks themselves just don't have enough capital. In other words, they like the loan, they just can't do as much of it as they would ideally want because they're capital constrained. But that doesn't seem to be the sort of core market failure that we've been talking about. So again, I don't quite see why they would want to play. So this is to David's point. If there was nothing else, if a bank just looks at this with nothing else and says, why would I make this loan to a firm that really we don't know is going to survive? I don't see why they're going to do it. Now, that's not a prediction. I think there is a good chance, I really don't know. We're going to learn a lot here in the next few weeks. There's a good chance that banks may participate if they've already got a loan, an existing loan to the company in question that's sort of troubled, right? So they've got an existing $100 loan, and if they put up another $5 and the government puts up 95, well, maybe we can sort of keep the company alive for a little while and gamble for resurrection. Then it's clear that the banks would like to participate. But then you may be getting them to over-participate in some bad loans, and then of course under-participate in loans where they don't have a big troubled stake, because again, it's not commercial unless there is the sort of evergreening thing. So Marcus, I agreed with you that we should be sort of, in some broad sense, evergreening, but it shouldn't be that the incentives are dictated by exactly how bad is the bank's position and how badly do they need to sort of get themselves out. So again, I just don't think that this risk retention seen in the context of the current set of problems that we have is sort of a helpful design feature. The other thing, again, I mentioned this before, that sort of worries me quite a bit is very fast. I mean, it's very fast. I expect them to pay back the entire loan. And just to scale things, you know, if you're not earning revenues for like 6 months or a year, and you've got a bunch of operating leverage, the loan that covers that could be many years of profits, right? So, you know, a year of revenues, a year of lost revenues is many years of profit. So you could be talking about a fairly sizable loan, and then asking people early on in the recovery to sort of service that entire loan or pay down that entire loan is difficult. Now, as I said, it is more moderate in the priority loan program, but of course then you've done again something which I think is counterproductive, is to create a very senior claim for the government, which is going to make it harder for them to bring on any kind of more junior financing. That's a sort of classic debt overhang problem.
So Jeremy,
Yeah.
So there's some questions here. So Daryl Duffy wanted to come back to the gap. Isn't it the whole thing magnified by a selection issue on top of it? If you're a company with a lot of employees and you have to keep your employees, you might be much less likely to be part of the program. but then a company which has almost no employees anyway.
Yes.
Hence, your numbers might be even larger.
Yes. Well, there was, I'm not sure this is exactly responsive to the question. There was another, what I thought was quite problematic feature of the first iteration. If you look at the first term sheet of this thing, there was some conditionality on the loan, on retaining your employees. I think the first term sheet said something like, the company must make best efforts to maintain their payroll. Well, then that's really kind of hard, because again, if you're not making any money, to take out a loan to pay the wages that are not doing for workers who are not producing anything, that's asking people to take on an incredibly uneconomic burden. Our view was always that labor basically just has to be managed with a grant. You can't ask people to borrow. It's one thing to ask them to borrow to sort of pay their capital costs, but to ask them to borrow to pay the wages makes essentially no sense. And that's the proper province of either unemployment insurance or something like the payroll protection program, which has a grant element to it. So that essentially that has to be fiscalized. I think there's almost no question that the labor has to be paid for. And a very good thing is in the more recent iterations of the Main Street term sheet, it now no longer says best efforts. It says something like commercially reasonable efforts to maintain employment, which I think is vacuous, is fortunately relatively vacuous. So it won't be too big a burden, one hopes. And you know, I think the intent is that if they need to lay people off because people are not producing, basically, that those folks can be covered by unemployment insurance rather than by the firm borrowing. Okay. I just want to come back to this last point about the hard debt claims, which I really worry about. Again, that you have either some combination of fast repayment and senior claims, so you're going to end up putting many of these Main Street borrowers in some form of distress. Again, at a time, call it 18 months, 2 years from now, and the economy is still fragile. At that point, I think you want to ask a question about, like, okay, if they are in trouble, who does the work out? Now, I think the Fed probably very much hopes, and this makes sense, that the Treasury, as the residual claimant, is the one who's going to be responsible, not the Fed. But then what does the Treasury do? Okay, given that they're side by side with banks, right? So the Treasury is like sort of doing this with the bank. It's going to be a little hard for the Treasury at that point to be softer in some sense in the workout. You might say, well, at this point, we should do some recontracting and say, let's defer the interest, let's reduce the principal, whatever. But I think it's going to be hard to do it on terms that are very different than what the banks would achieve kind of in a more private market workout. And indeed, I wouldn't be surprised if the Treasury is not eager to essentially delegate the management of the workout to some kind of third party. They don't want to be having to make these politically fraught decisions of, do I sort of work out this firm in this state and not work out this firm in another state? So you can imagine that this stuff is sort of alienated to some kind of workout party. And if it's done on terms that are essentially what banks could achieve, you worry that the banks, and again, these are senior loans and they're being structured purposefully. Let's think about this priority program as senior loans. We know from sort of a large body of work that relatively senior lenders with strong collateral positions may be sort of relatively liquidation prone relative to some kind of socially efficient thing. So the hardness of the claims combined with the fact that you're in partnership with the banks and that you're going to have some political imperative or impetus to doing things on terms that are not too interventionist ex post, I think can lead to sort of a problem. So again, on pure just design, on corporate finance design, leaving aside the quantities and who you're lending to, I would much prefer something that looks like preferred, okay? So preferred, again, it's a fixed payment, but there's an ability to essentially defer those payments without forcing companies into formal default. The claim is more junior, so it's easier to bring on other financing without sort of debt overhang. And again, if you're concerned about the relative junior position, you can strengthen your overall claim by adding something that looks like warrants. And again, that's what you see in kind of riskier
Jeremy,
environment. Yeah.
So Adriano Rampini would like to know, if you take more junior claims, it's of course more risky, and given the size capacity might be very limited.
Yes.
Don't you can make way less than compared to what you can do with more senior claims?
Okay, so that's exactly the next slide. So again, I think the right way to think about this is exactly what Adriano has said, which is, let's suppose I have the same amount of budget authority. Okay, I'm not asking for more budget authority. I don't want to put the Fed at meaningful risk. So if I want to make riskier loans, by definition, I can make fewer loans because I'm going to have to put up, if I'm lending to single B rated firms, I have to put up more treasury capital per unit of loan. Okay, so I think that's exactly the trade we sort of want to sign up for. We're willing to, we're willing to give on the lend without limit sort of aspect of Bagehot in order to get some of this optionality. Okay, so in our preferred design, there would be caps. So these things don't have caps other than, the absolute loan size has to be less than 25 million. Okay, we would have firm level caps. And basically the way to think about this is, what do you need? What does a firm need to just cover its fixed obligations, to pay its rent and its interest and its lease payments? Roughly, think of giving them only enough to survive a quarter. You don't give them upfront enough to survive the whole year. Okay, you give them enough to survive a quarter, and we have it's pretty easy to calculate off their tax return what, roughly speaking, those fixed obligations are. Okay? So, again, this is a little too simple, but what do you need to get through the next quarter and pay all your, paying on your interest, your lease, your mortgage, that kind of thing? We give you that. Okay, then a quarter later, we come back and we have another look. Okay, if the economy has branched up and so things look a little bit better, at that point, you're a little more comfortable extending more credit because basically your position has gotten safer. Okay, if things have gotten worse, you're not going to give quite as much. So you might have ex ante thought, I'm going to, on average, lend 6 months worth or 9 months worth. But along the tree, if things go well, you might advance a year or even more than a year's worth if we're really on the kind of good branch. If we're on the bad branch, maybe after 3 to 6 months, you start winding it down. At that point, you are putting guys into distress or into bankruptcy, but you're doing it once you've learned basically that now we really do need to restructure firms, that a bunch of people really won't survive. And, if you think about, again, this sort of flatten the curve, you'll have done some flattening of the curve, which may have a virtue in and of itself because the bankruptcies will take place in a somewhat less congested bankruptcy system. So I think that's exactly the spirit. I'm not, again, as I said, we're sort of proposing very minor tweaks. And among these minor tweaks, we're not thinking of asking for more budgetary, more loss-taking authority. It's just how do we allocate that, not to give it all to the sort of guys who look ex ante most solvent, but be willing to take a little bit of stage risk on some of the others. Okay, so that's
Jeremy,
basically the story. Yeah.
Greg Menkew would like to know, your colleague, he quoted Larry Summers saying that Larry thinks that, government is a crappy VC or venture capitalist. It seems like you have a totally different view that the government can act like a venture capitalist. Or do you think it's a very different scenario we are in now? Do you agree with that?
Okay. Yeah, so of course, I invited trouble for myself by using the word venture capitalist. So, venture capitalist, I guess there's two aspects of it. There's picking the companies, and then there's conditional on who you've picked, what's a sensible structure. So for example, some of what we're saying when I've been invoking venture capitalists, you wouldn't change anything about the program in terms of anybody who's admitted to it, but I would prefer the debt claim be a preferred claim. So that has nothing to do with picking. That's just conditional on a set of relatively risky firms. How do we finance efficiently? And the same thing, again, I would be willing to take a little bit more ex ante risk. I'm not doing any firm by firm selection. No firm by firm selection. I am willing to sort of include single B and double B rated firms on the notion, this is just sort of a broad, there's a view, but there's a broad view that that's exactly where a lot of the problem lies. But there's no, if the Larry quote had to do with sort of the government picking winners and losers, there's no picking whatsoever. Now, in fact, the one unfortunate bit of picking here, and this goes back to David Wessel's question, is the banks as a gating mechanism. In theory, you might like that because you might say, oh, there's some private sector incentive alignment and they're going to make good picks. But of course, their thing is terribly contaminated by their pre-existing positions. So I think, what are the banks going to like? They're going to just like the things where they have the most sort of, they're going to want to throw good money after bad to some extent. So we're not in a great world in terms of able to pick. But again, the modest tweaks here are just trying to like sort of have a somewhat more efficient financing scheme. And again, something that looks less like hard debt lender of last resort. So I did not mean to, and I apologize for the implication. I did not mean to suggest that we're like Silicon Valley and we're like really clever about which firms should survive. And that's it. So that's kind of all I had to say. If there's time for a couple questions.
Yeah, I would like to have two questions. One comes from Joe Stiglitz's presentation earlier. Perhaps you have some take on that too, because you mentioned Chapter 11 on bankruptcy. The bankruptcy courts be overcharged. What he proposed is some super Chapter 11, which would deal with many companies in one setting, and would also take the externalities into account. If you have a bankruptcy in one company, it causes externalities on the others. It would internalize these externalities, and might be more efficient also to deal with what you mentioned initially, to deal with that the courts would be overrun, essentially, with so many tasks. Mm-hmm. Do you have any take on this? Would this partially?
Well, I surely agree with sort of the premise of this, which is, you can see, and this runs through kind of this whole thing, the ability of the bankruptcy system to kind of efficiently restructure the financial claims without damaging kind of the real side of the business. That is an enormous pinch point here. So to the extent that one can pragmatically relax that, I think that's very, very valuable. As a practical matter, it's hard to do sort of one size fits all, because I think the problems are different for different types of firms. So for example, for small firms, there's a very strong tendency towards liquidation. You could imagine trying to design something that can put small firms rapidly through something that doesn't always liquidate. I struggle a little bit more, but of course, some of the inefficiency sometimes comes from excessive continuation as well. And in fact, in Ben Iverson's work, what he interestingly found was that when the courts have less time, they actually put more people into Chapter 11 and fewer into liquidation, and there's sort of excessive continuation as well. What seems to be harder to easily design is a simple mechanism. I think you can turn the dial on the bias, more liquidation or less, maybe with a simple mechanism. I don't know that you can get kind of case by case sort of right outcomes. It may be that you make a judgment that will preserve too many firms, but it's a good thing to basically try to avoid liquidation altogether. If there's another mechanism that can do that, I think in this particular case, that might be a good thing. Okay, but again, it's tricky. It's tricky. It's not a panacea, because if you avoid liquidation altogether and you sort of allow everybody to continue, that's very good for the physical capital. That's probably pretty bad for some of the lenders. And then you're going to have to deal with the banking problem. The whole doesn't sort of go away. You'll have to deal maybe with more of a banking problem.
Let me
we can improve Chapter 11. Absolutely.
There are two aspects which, when you look at this staggered lending, one is which company can survive a long recession. Let's suppose it might be a long recession. And so one dimension is the length of the recession, and the other dimension is where will we end up. It could be that the recession might not be so long, but the economy will look very, very different. So we will only do online shopping, retail space will go away.
Yeah.
So your scheme would take both dimensions into account.
Ideally, if we learn, so, suppose we're in the early stage, we're lending pretty indiscriminately. And then we realize 6 months from now, retail is just not going to survive, or some subset of retail is not going to survive. That's exactly the point. You don't want to give the retailers enough money to go for a full year or 18 months. You give them enough for 6 months, and then the right thing may well be to exercise the bankruptcy option. Exactly. And now, of course, I don't want to presume too much of this is going to come back to Greg's question. I don't want to presume too much government cleverness in all of this. I don't want them to be the pickers. But one way to do this is there are tranches of this program, and the tranche sizes, the overall tranche sizes get smaller. And then next time around, nobody, good or bad, gets their full next 3 months paid for. Maybe they only get one. And then you hope that the private market will sort of fill in for the people who are doing better, and the ones who are not will sort of fall by the wayside. But, it's just sort of a mechanism design kind of problem. How do we, with a minimum of, firm-specific information, try to prove as much market-wide information into this kind of staging as we.
And this shares a little bit, Stephen Ciacchetti is asking, the central banks, when they would follow your proposal, go really in uncharted territory, and because they will decide when to cut off the funding and when not. That's what is worried. And then Damuni Olivier, he would like to know what is the implication for rating agencies if they don't know how the Fed in the future will refund it or not. Makes this whole rating game much more complicated?
So what I think the best way to do this now would be, again, you don't want the government in any kind of picking business, but you could imagine that the program has tranches to it. And in fact, this may happen anyway because Congress may reauthorize, like the PPP, may reauthorize another slug. So all they would say is, it's just putting one more limit. Right now, you can apply for so much as a function of, again, your fixed obligations. And then there'll be a second tranche, which instead of being 100% of your next 3 months fixed obligations will be 50% of your next. And you can either decide that ex post, that leaves a little bit of discretion, or you could almost try to outline that now. Even that, I think, would be better. So again, I'm trying very hard to respect no firm level decision ever. But I think you can still improve. You can still do some of this. I'm surely not the first best, but I think you can do some of that. As to Olivier's question about the rating agencies, I don't know. I'm not sure they're my biggest concern right now. But yeah, it's obviously, we're in a world where it's so hard and their job is harder as well. I'm not quite sure what they should be doing.
Okay, thanks a lot, Jeremy. That was fantastic and having a new perspective how to conduct monetary policy, and take on some credit risk in a particular form, which might help out in these circumstances in particular. Thanks a lot. And I would like to do some advertising for Friday. Friday, Paul Krugman will talk about on the audacity of slope. It's a play on Obama's book title. And then we have the next Monday, John Cochran talking as well. Thanks again, Jeremy, and hope to see you soon in real life, not just over Zoom. And
thanks again for giving me access to this great audience. Thank you.
Thanks to the audience as well for being here and hopefully coming back again. Bye-bye.